Hi everyone, and welcome to our YouTube live, where we'll be talking about what the Fed's been talking about, and hopefully we'll kind of summarize what they've said, look at what the market reaction has been so far, but also put it in a wider context as investors, which is why we care after all. So just to start, obviously they didn't change policy. This was widely expected. That's what markets had priced in, so no surprises there. I think the other important point is that it is still looking very much like a soft landing, in the sense that there hasn't been a big pickup in in unemployment in the United States, and so there hasn't been a big recession, there hasn't been a weakening of economic growth, not a significant one, and at the same time the imbalance between supply and demand in the labour market in the United States has come back into a more reasonable balance. So it does look as if, particularly as we just had an inflation print which looked pretty good, and you don't read too much into a single data number, but into a single print, but it does look quite optimistic from the Fed's point of view. There was a period we had 3 successive prints of inflation which looked high, and the Fed initially described this as a bump in the road, but then said, look, we have to take signal from that, as they put it. And so that was a clear sign that inflation wasn't coming down as they expected. But now things are looking a little bit better. Soft landings on the cards still, which nobody expected a year ago. And so it's looking pretty good for the Fed, but still not confident enough to start cutting rates, unlike other central banks around the world. And while we're on that subject, let me just pull up our podcast, Many Happy Returns, because we did an episode, an entire episode about this, and we were talking about central banks cutting rates. Let me just show you the page so you can find it. You'll be able to find this on Spotify, Apple Podcasts, wherever you get your podcast. And I'll share that with you, hopefully. Yes, here we go. Interest rate cuts coming to a central bank near you. And I do this with my co-host, Michael Pugh. He's just brilliant. And he always adds so much to the episodes. And I think this was a good one. And what was surprising this time around is what usually happens is that the Fed cuts first, then the Bank of England, then the ECB. Whereas this time around, it's the ECB that went first, which is very unusual. Not great economic growth in Europe, so you can kind of see why they'd want to ease off very restrictive policy earlier, whereas the US is seeing stronger growth, so they can afford to be a bit more aggressive with their monetary policy without crashing the economy. I can hear a scratch at the door. That's a premature cockapoo. You're supposed to wait for the questions, mate. You're supposed to. Oh. He's going to be running up and down these stairs. I can tell it straight away. This is the summary bit. You don't come for that. You come in the quiet bit between the questions. Go on then, you can have one. Where's the hair on? There we go, Ted. How's that? Good? Yeah? Or his tail's wagging, so I assume that's good. What did you think about the Fed, Ted? Any good? What does it mean for markets, eh? You go back to Mummy. She's down the stairs. Go on. She'll give you the biltong. That's it. Go on. Go, go, go. Right. So, photo bombed by a dog. Right. Yes. So, like and share. Do listen to our Many Happy Returns podcast. That was very good. And it talks all about monetary policy, not just for the Fed, but for the other central banks, why they're cutting, and also the stickiness of inflation. And yeah, so back to tonight. So what I'm going to do now is just briefly run through what was said. We've also had an update of the summary of economic projections, which is just a brilliant way of seeing into the minds of the FOMC members to see what they think is going to happen for growth, unemployment, inflation, and for their policy rate. So the dot plots are a really useful communication tool, I think. A lot of people poo-poo them, but I think they're great. Anyway, they updated that, so we'll have a look at that. We'll also have a look at what markets were expecting. That's kind of interesting. And I'll go through the press conference and some of the statements that were made. And then I'll throw it to you and you can ask questions about investing. Usually it's nothing to do with the Fed, but ideally ask questions about policy, but you can ask anything you want to do with finance. Okay. So let's start off with their statement, their policy statement. And this is what they said. Nick Timraus, the journalist from the Wall Street Journal, who I really like, he's written a brilliant book called Triage, $1 Trillion Triage. It's just so good. I'm reading it at the moment. And it's brilliant. It describes what happened during the pandemic and lots of little nuggets about all the players and turning them into human beings, about how policy's made, but also how that terrible period during the pandemic, how the Fed essentially saved the day, and the incredible measures they had in place in order to backstop the treasury market, the MBS market, the corporate bond market. And it's their policy which very quickly turned around the big sell-off that we saw. Anyway, here's the statement. No change in policy. And what this also shows is a difference between the previous statement in May to the current statement on June the 12th. So instead of a lack of further progress towards the 2% inflation objective, remember that bump in the road, we just got a good data print, a good inflation print today. It's modest further progress towards the 2% inflation objective. Remember, in order for it to be, for them to cut rates, it has to be more than modest. It has to be sustained, and they have to be confident that there's a sustained move back to the 2% target. Then they kind of claim, they lay out the fact that they're attentive to risks and the economic outlook is uncertain. And yes, they kept they kept the policy range the same, 5.25% to 5.5% currently, and also that they would carry on reducing their holdings of treasury securities and agency debt at the new slower rate. And all of the new language about the new rate was taken out because that's not new anymore, and the people who voted. So overall, no surprises. This was interesting. This is Nick Timraus's tweet about inflation. And what's kind of interesting here is how surprisingly low this latest print was. So 3.4% increase from a year earlier, lowest in 3 years. And if you kind of smooth out the bumps by taking the 6-month annualized change, a 3-month annual change, you can kind of see the downward trend. And, are we miles above the 2% target? Well, 1 percentage point, 2 percentage points is quite a lot, but it is heading the right way. And remember, the Fed has to act because of the lags of the effects of their monetary policy. They have to act before we get there. So that's the important thing. If we look at what happened in markets, this is Joe Weisenthal from Bloomberg. You can see that there's been a bit of volatility, but nothing catastrophic, and markets pretty much recovered to the highs of the day. So no nasty surprises, no new information really, I think, for the stock market. That's the key point there. Move over a bit. So now let's move on to that summary of economic projections. Make myself a bit smaller. And this is the data that we just got updated. So the one which is kind of interesting, which has changed a little bit, is the federal funds rate projection, right? So this is the monetary policy path. That's the important thing. So 2024, by the end of this year, the federal funds rate currently, the median expectation for members of the committee was 5.1%. Previously in March, it was 4.6. So you can see that whereas previously they thought there'd be 2 rate cuts, the median projection is now for maybe 1, maybe 2. By the end of 2025, we've moved down to 4.1%, again higher than it was expected to be in March, and then for 2026 about the same. The long run average also has moved up a bit, but I wouldn't read too much into that. And there was a question that was asked about that, which Powell kind of shrugged off. But this is what it looks like if we actually look at the individual numbers. So each of these dots is one member of the committee's expectation about what's going to happen, where their policy rate will be for 2024, 5, 6 and over the longer run. And you can see I've put in black where they were in March, I've put in red where they are now. So it looks like 1 or 2 cuts are expected for 2024. So that's over the remaining part of this year, which is less than was the case previously. So they've taken about 2 cuts off the table as inflation proved to be more sticky since the previous SEP. Now it's interesting, again, Nick Timrouse translates that. He says, 4 Fed officials see no rate cuts this year, up from 2 officials in March. So twice as many Fed officials don't think they're going to cut rates this year. And we're only halfway through. 7 see 1 cut, 8 see 2 cuts. So some still do see 2 cuts. And the median, of course, is about 1 or 2. So a narrow majority sees no more than 1 cut this year as a base case. So let's now look at those expectations as they were this morning. And every time I do one of these, I kind of look at the FOMC, the Fed Watch tool from the CME, and this tells you the probability of rates being at a certain level for every one of the policy meetings from the Fed. So here is May 2024. So that's as it was last time around. This is in May. This is as it looks now. In May, they were expecting the first cut to be in December. This time around, they thought this morning, they thought the first cut would be in September, but not today, right? So this is the June meeting, July, September, November, December. So 1, 2, 3, 4, 5 meetings left this year and only 1 rate cut priced in, which is roughly in line with what the Fed is suggesting is going to happen with the summary of economic projections, the dot plots, which is good. What's really worrying is when there's a huge disconnect, which can happen, between what the Fed says in the SEP and what the market thinks. But that's not the case at the moment. In fact, if anything, the markets are looking a little bit more hawkish, expecting rates to remain higher for longer than even the Fed committee members. But of course, this was before we saw that CPI print that these numbers came out. So now let's take a look at the press conference. There was a balance sheet one, so the balance sheet continues to shrink. We were at 9 trillion, we're now just a shade above 7 trillion. It's shrunk by about 19% overall, so a fifth of that outstanding treasury and mortgage-backed security debt has now matured. Remember, they're not selling, they're just waiting for the bonds to mature and then presumably paying it back to the treasury. So now let's move on to the press conference, and I'll go back to me speaking and I'll just read through my notes. There was one question that was kind of interesting, which was, is there more cooling required in the jobs market? In other words, are Americans going to have to lose their jobs before you're confident that inflation is sustainably moving back to the 2% target? Have those people been justifiably sacrificed on the altar of Fed confidence? And the response was that clearly the jobs market was overheated 2 years ago. Now it's in much better balance in terms of supply and demand. The labour force supplies come up quite a bit through immigration, so that's seen as a positive because it's keeping wage growth down by increasing the labour supply, and also recovering participation. If you look at prime age workers in the United States, that's between the ages of about 20 and 50, that's been increasing. So that again increases labour supply and brings supply and demand better into balance for the US economy. And so all of that's looking quite positive, and the quits rate has moved down, and that's because labour market isn't quite as brisk as it was. So people leaving their jobs, there are less of them. This is something which the US monitors. What proportion of workers are leaving their job is called the quit rate. And when that moves down, people are less confident about moving into a new job. And so that suggests again that the labour market tightness is easing, and that's good for inflation. Not so good for workers, of course. And unemployment has been creeping up now, 0.6 over the course of a year, but very gradually, which is kind of good, right? Because if you remember how the SARM rule works, actually, let's show the SARM rule. I love this. Let me see if I can pull up the SARM rule. So what this does, what a really good indicator is of US recessions, is how rapidly is the unemployment rate picking up. So Claudia SARM came up with this rule, which hopefully you can see if I move my ugly mug up here. So what this does, it goes back to 1960. The shaded bits are US recessions, and the SARM rule is this blue line. And what that does is it looks at the rate of increase of U3 inflation, it's called. It's just one definition of unemployment. U3 unemployment. It's an unemployment measure in the United States. When that rises by 0.5 percentage points or more relative to the minimum over the 3-month average, the minimum of the 3-month average from the previous 12 months. So essentially that's kind of smoothing the unemployment rate and then looking at the minimum that it reached over a 12-month previous period. So really it's just kind of anchoring based on a moving average to see how rapidly the current rate of inflation rate of unemployment is picking up. And when that rate of unemployment picks up rapidly, that's an indicator that people are losing their jobs, the US is in recession. Seems crazy on the face of it to do that. But in fact, it's a committee which decides when these recessions occur. It's the NBER committee. And they often do it with a lag. You don't find out until 6 months afterwards. Whereas this thing updates on a monthly basis every time they publish the labour report. So notice how at the moment it is picking up, right? So it's increasing to 0.37. The trigger level is 0.5. And so we're not quite there. And so the fact that Powell pointed out the rate of growth and how much it had increased shows that they kind of got one eye on this indicator, which is kind of interesting, I think. But anyway, yeah, so they are seeing the unemployment rate tick up. And this is why it matters, because it's a very, very good US recession indicator. But it's coming off, multi-decade lows in unemployment. So that's the good news. So 4% unemployment is historically low, but it's moved up a little bit. It's softened a bit. And you've still got good job creation. So if you look at non-farm payrolls, the number of jobs being added to the economy, that's still pretty brisk. So there is a bit of a disconnect here between non-farm payrolls, which is the number of new jobs, and the unemployment rate, which is actually increasing a little bit. So you're seeing lots of new jobs being created according to one survey, and at the same time you're seeing the unemployment rate increase slightly. So there's something not quite right there. So there has been some commentary about that. But overall, I think he's right that it is just ticking up slightly. So nothing to be very concerned about. There was a question about the long run interest rate forecast. Remember that long run average in the summary of economic projections. Is that a sign that policy is not as restrictive as you previously thought it was? And Powell just kind of shrugged that one off. And he said, what's really important is that we use the current state of the economy. All this stuff about long-term averages is kind of theoretically interesting, but the day-to-day job of setting monetary policy is much more anchored on current data. So that was kind of interesting. So I wouldn't read too much into that long-run rate change. It was a pretty small change anyway. What else was interesting? Oh, this was an interesting one. What's your message to Americans who are seeing encouraging economic data but don't feel good about the economy? Which is a brilliant point. If you look at the US and you look at how people feel about the economy, you could just draw a line between Republicans and Democrats. And Democrats are kind of okay with the economy. They're quite positive about it. Republicans very negative. They live in the same America, but it's like they're seeing two different economies, which is interesting. And Powell's response was interesting. He said, it's not our job to tell people what they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labour market with unemployment at 4%. It's been a long time since we've had a stretch of unemployment at or below 4%. A very long time since that's happened. So that's also positive for the average American. You can find a job quite easily. And then he said he's confident they're going to get to the 2% target. Yeah. And long-term high inflation is what's really painful. There was an interesting question from the FT's journalist, Rachel Jones, I think her name is, who said, what's encouraging in the data? What are the positives that you're seeing? So, he said, well, the economic growth is good. The solid growth has been very encouraging. If you go back a year, there was a big concern about slowing growth in a recession. Many forecasters were forecasting a recession. That's not what happened. It's a sharp distinction with many other advanced economies around the world where growth isn't so good. The ECB in Europe, the UK, for example, not great growth in either of those two regions. But so the inflation report today is encouraging, but it comes after several reports that were not so encouraging. So that was the blip, the bumpy road. And then the other kind of interesting point is about what's keeping inflation high. Shelter forms a really large proportion of US inflation. And shelter's been surprisingly sticky, and the Fed has repeatedly said, we know it's going to come down. We know it is because rents are falling. So they think this is some kind of lag effect. And then he tried to explain what the reasons for that were. He said there's a sort of bulge of high past increases in market rents. It has to get worked off. And that may take, several years. So it's going to be sticky for some time to come. But market rents remain going up at relatively low levels. So this is going to happen. It's just going to happen more slowly than we thought. So effectively what he's saying is, yeah, it's going to come down. It's just got a big lag. So that's the long and the short of it. So that was the kind of gist of the press conference. Those are my kind of favourite questions. Let's see if there's anything else really striking before we go on to questions. No, I think that's pretty much it. And yeah, let's move on to your questions now. I mean, I could just blitz you with graphs, but I'm not going to do that because Laura told me off. She said, too many graphs. I like graphs. But there we go. So yeah, please do ask some questions. I will summon the dog again, although he did come up prematurely, and I've still got some treats in the box, you see. And we'll see if we can get him to come upstairs and do some tricks, hopefully. And let's see what we've got. So yeah, so do ask a question. If you're a supporter on YouTube, we'll push you to the front of the queue. And if you do a super chat, obviously, we'll push you to the front of the queue as well. So please do super chat. Please do like and subscribe if you like our content. Listen to our podcast. It's very good. You can do it while you mow the lawn. There was a chap today who was saying, I will listen to your podcast while I'm mowing the lawn. He must have good noise cancellation in his earphones. So yeah, a lot of people tell me they do it while walking the dog or while doing jobs around the house. So there we go. But yeah, do have a listen. Oh, that's very loud, isn't it? Just see if I can decrease that. Yeah, I'll mute it. There we go. Right, so let's summon the dog. Teddy! Ted, treat! Oh, here he comes. Oh, yes. Look what we've got. You're not going to be sick, are you? Should we do a trick? You're going to stand for me. We do stand. Okay, right. So you can't rest on my leg. You have to. That's it. Oh, very good. Oh, you're clever. Good boy. You clever sausage. He's very good. Oh, he's licking my hand. Oh, Teddy, you're not going to vomit in here, right? No, all good. Very good. Do you want to go back to Laura? You know, she's going to give you some built on. Yeah? And then see if we've got some questions. Yeah. Built on downstairs, mate. We're running short on biltong, actually. He's been hitting it hard. I think Laura steals his biltong. I think she steals it. Go on then. Go, go, go. He's off. Right. Let's look at questions. Yeah, do ask a question. And has Laura sold Nvidia yet? There was a graph showing Nvidia as giving most of the S&P 500. Yeah, that's right. Phil Curtis says, did you buy at the top? Okay. Very good. Yeah, Laura's done really well with Nvidia. You know, she sold, when it doubled, she sold half of it. And it just carried on going up. It's very annoying. Mark's World says, hi Romin. Hi Mark's World. Hi Alex M. 111 says, let's go. Hi from Danny. Hi from Canada. El Mayo says, hi from Canada. Hey, hey from Canada. And great podcast. Phil Curtis says, thank you, Phil. And thank you on behalf of Michael. He does a great job. Martin A1 says, we're clearly in recession and have been for 3 months. Okay. Markswell says, Ted must be hungry. Woof woof. Jared McCann. Michelle says, or Teddy. Yes, he's very sweet. Let's see if we have any. Oh, we do. Lovely. So there's a GCT Prompt, who is one of our supporters, who says, hello, are you familiar with the FAS ETF? Oh, I'm not. How exciting. I always like a new ETF. If so, what's your opinion of it? Well, it's not so, but I can have a look at it. Oh, okay. Yeah, let's have a look at this puppy. Right, and I'm going to share my screen so you can see it too. So here it is. So it's a 3 times levered daily financial bull and bear. So it seeks daily investment results before fees and expenses of 300% or 300% of the inverse of the performance of the financial select sector. So I assume that's financials. So it either goes long or short, and it must have some kind of trigger to decide which way to go. Let's just see if we can figure out the switching mechanism. Let's see, fact sheet, that should help us. These leverage ETFs seek a return that are 300%, plus 300% or minus 300% for the return of their benchmark index for a single day. So it's not a long-term multiplication of return, it's a daily multiplication. So you kind of short gamma any leak value if it's a very volatile period which doesn't trend. And how does it switch? So the target index is companies from the following industries: banks, thrifts and mortgage finance, diversified financial services, consumer finance, capital markets, insurance, mortgage, real estate, investment trusts. So stuff which is got a high linkage to the welfare of the economy, and also which is probably quite rate sensitive, which is interesting. The top 10 holdings: Berkshire Hathaway, JP Morgan Chase, Visa, MasterCard, and so on. And it doesn't tell me how it switches, which is unfortunate. So I guess you've got a positive one and a negative one. And FAS is the positive one. FAS is the negative one. So, would I ever buy a leveraged ETF is the question, I guess. I'd be kind of loath to do it. Firstly, the expense ratios are very high. So it's about almost 1%, which for an ETF is just staggeringly large. I guess the other point is, if there was a crash, right? If there was a really bad economic event, the time when I'd buy one of these things would be during the worst, the real awful bit of that crash, in the full knowledge that it had already sold off a lot and may sell off even more, but would eventually recover. Because remember, what this is tracking is an index of multiple banks and multiple financials. So it's not the case that it's going to go to zero. Well, I say that, but let's have a look at FAS first of all. Yeah, here we go. So this is the plus 300 version of the index. So let me share this with you. So this is what the price of the index looks like. And I've got no idea where my face is now. 1 second. I just dragged it into oblivion. Minimize that. Okay. So that is picture in picture. Okay. I'm not going to be able to fix that. Okay. So you can see that the what I've overlaid here, I'm going to unoverlay, is the S&P 500. So the S&P 500 is in blue, and then you can see this fund in black. So there are certain periods when it massively underperforms during a market crash. So this thing fell, what, something like 20%. Is that right? It fell from 100 down to 20, so it fell 80% over a fairly short period of time, over about a month. And then huge rally. So the point at which I buy would be after it had crashed. That's the kind of period when these things are kind of attractive. So as a recovery play, I might consider it. The time when I really be uncertain about what would happen is going short. And the reason for that is that you can't predict these crises before they happen. Eventually things do recover. So you know that if you go long, it will recover. And the cost of carry is the fee, which is almost 1%. And there will be a lot of volatility, which may bleed away some value from the fund as well. But I think that's the time for these 3 times leverage things. And I'd go 3 times leverage long after a sell-off because things would recover. What I wouldn't do is go short just because I thought something was around the corner that might trigger a sell-off, because I just know I couldn't call that. So, that's the way I would approach it. I think, these things are almost impossible to call when you do get one of these unpleasant events, but that's the one I'd go for. GCT prompt also says, as a follow-up, I'm 90% up on FAS since I bought FAS. Well, that's great. But remember that, tomorrow you might be 70% up, because these things are so volatile. So it's not a kind of long-term hold and just kind of leave position. It is quite stressful, I think, having to buy one of these things. So, my core will always be buy an index, hold it for a long period of time. 90% of my money is in that. It's in a single fund, which is long global equity. My fund portfolio, which makes up 10%, I worked it out today, it's 13%. 10% of my overall wealth. That's where I play around with stuff like this. And if I lose all my money, it kind of doesn't matter, but I learn a lot. So, if I was going to play around with this, that's where I'd do it. But interesting ETF. and clearly it's worked for you, which is good. I applaud you for that, but personally, yeah, I don't do that myself. See if I can find my cursor. It seems to have disappeared. I did find a way to fix that, but of course I can't remember. Okay, so the picture-in-picture will not work, but the webcam does. That's good. So back to your questions, and there's one about, yeah, do like and share. That would be great, and we'll give it another 20 minutes. So please do super chats. Those would help us a lot as well. Do listen to our podcast. Very good. And back to your questions. Oh, super chat. Thank you very much. And thumbs up. That's very kind of you. See if we know who that is. Laura will tell me in the document. That's good. But I appreciate that. Thank you. Let's see if we've got some questions. The French election results seem to have spooked the markets a bit. Can we expect more if Macron loses? Yeah, I mean, it has been surprising, some of the electoral changes in Europe. I listened to the Rest is Politics podcast in the UK, which is great. And they often talk about elections elsewhere. And I think what's interesting is the advancement of the far right groups, but also far left in Europe. Normally what you'd expect is that those groups would do well if there's real economic problems, like incredibly bad economic problems. And the problem that many people face at the moment is they're still getting used to the fact that prices are so much higher. The rate of inflation slowed down, the rate of annual change in prices. But if you look at where prices were just a couple of years ago, we're about 30% higher. And that doesn't go away unless you get deflation, which is really bad as well. So I think that's part of the reason for it. But I think people are also disillusioned with politics, and that's pretty clear across Europe, across much of the world. It's true in the UK as well. You know, that's probably why there are such crazy differences in the polls for UK parties like the Conservatives and the Labour Party. But I think if Macron loses, it would be pretty shocking. Simply because I think what we've seen is the rise of populism, and populism works up to a certain degree. It kind of gets you into power, but then you have to deliver, and you may be able to fool people, but you can't fool the economy. And if you don't deliver on the economy, eventually people get disgruntled. So, for example, in the UK, we had the Brexit Party, the Conservatives, in power for so long, and yet I think people were dissatisfied with the rate of growth, with their job security, with house prices being out of reach, and the increasing divide between very wealthy people and people who are really struggling. So I think that's behind a lot of this change in politics. And if we do move to some kind of populist government, which is anti-Euro and anti-Eurozone and anti-ECB, well, that can only mean disruption for markets. And that's not good for equity, it's not good for the bond market. And a fragmentation of the Eurozone may well lead to war. It's very unusual for an economic union and for a currency union to break up without a war. So clearly, that's not the world I want to live in. And that's clearly what has markets spooked, because the economic policies of a populist often are not good for the economy and not good for markets. So I think that's the concern. El Sabio, who asked the question. A question from Daniel Cooper. Let me just check if we've got any members. Yes, we have. So the super chat was from ENP. Thank you. In sterling. Who asked, are enhanced money market funds a wise option for one's safe bucket at the moment? E.g., Royal London Short-Term Fixed Income Enhanced Fund. Best of both worlds between bonds and money market. I'm not familiar with that one, so let's have a look at it. There is a Royal London money market fund which is in our cheapest funds spreadsheet, but I wasn't aware of this one. I can see if I can find the fact sheet for it. I can find it on the Hargreaves website. Well, let's have a look on Morningstar. That's usually pretty good for these things. Yeah, I have lost my picture in picture. That's not good. Okay. Right. So let's see what we've got. There's a description. Well, firstly, the interest rate sensitivity must be low. Okay, medium. So the credit quality is medium. That's pretty odd. So I assume that's what the enhanced bit is. The duration is short, 1 year. And the credit quality, I assume, is what's generating the extra return. So it's buying this Lloyds Bank 5.8% coupon bond. So it's taking some credit risk. And the coupon on that is 5.8. Royal Bank of Canada 1%. Scandinavian Bank, I don't know what the coupon on that one is. National Australia Bank 5.7. So it looks like what it's dialed up is the credit risk to generate extra income. It wants to achieve a total return over rolling 12-month periods by generally investing in short-term fixed income securities. Invest at least 60% in short-term fixed income securities. I wonder if it's got a credit quality breakdown for this thing. No, pity. Usually it's pretty good on Morningstar. Let's have a look at the portfolio, just see if we can find the credit ratings. Yeah, so the effective duration is short, so you're not taking much interest rate risk. The average credit rating, not too bad, AA minus. But the weighted coupon is pretty high, 4.2. Corporate debt makes up 35% of it. I'm guessing that's all investment grade. And some securitized debt, 27%. Oh, here we go. Here's the credit rating distribution. So single A, about 37%. Yeah, so what it's done is just gone down the credit quality spectrum in order to increase the yield and the income you receive with this. So let's see if we can find the annualized yield on this thing. 1 year, 2.37%. Total return 6.8. Yeah, so it's giving you a bit of juice above what you'd get with a money market fund, and it's doing that by taking more credit risk. So I guess the risk here is that there is a big sell-off in the corporate bond market and that there's some kind of credit shock. And if that happens, this thing could lose quite a bit of value. But you can look at the price of the thing and it is fairly steady, it has low volatility. But notice what happened in 2022 is that it fell quite a bit. Let's see if I can get the thing in SharePad as well. See if I can find SharePad first of all. And we can have a look at the price of this thing. There we go. So there's the ISIN code. And here it is. I put it alongside the S&P initially just so you can see it. So you can tell it's an income fund because the price falls every time it pays a coupon. And take away the S&P. And I'll add CSH2, which is the Amundi money market fund. And I'll put all instruments. No, I don't want to add it to portfolio. Create CSH2. Chart, add, take away the S&P 500 and add CSH2. Here we go. So CSH2 is in blue. That's the accumulation money market fund. This one is an income, so that's an accumulation fund. This one's an income fund, so you can't compare the two. It's a pity there isn't an accumulation version of it. Oh, there is. So the accumulation version, the Y class, we can compare that with CSH2, which doesn't take any enhanced credit risk. It just earns the SOFR rate, the SONIA rate, the Sterling Overnight Index average rate. And you can see this thing has outperformed. There were periods when it outperformed quite a bit, when interest rates were low. Now that the SONIA rate is higher, it is still outperforming, but not by a huge amount. It's certainly more volatile, so you are taking more duration risk, maybe more credit risk, definitely more credit risk. But I'm not convinced that that extra return is worth it, given what's happening to a unenhanced fund. The return just doesn't look to be worth it if you compare the accumulation version of the fund. Maybe I'm looking at the wrong share class, but the Z class, yeah, similar story. So yeah, I'm not convinced that's a great buy, because you could earn a similar amount without taking the enhanced credit risk. If it is taking much credit risk, I'm not sure that it is taking a huge amount. Next question is from Gerard McCann, who says, view on gold moving forward if inflation is up or down. Thank you. Well, certainly what happens with gold long term is that it tracks inflation, not religiously, it doesn't track it exactly, but long term it tracks inflation. That's true. So let me just try pulling up our model for one of our trackers. So if you remember our website, premium website membership, if you've joined our premium website membership, you get access to these trackers, and the one which I'm interested in is fair value, and this looks at a fair value model for gold and silver. Now the inputs to this thing are inflation, the level of inflation, and also the trade weighted dollar, because it's priced in dollars, so if the dollar's weak it pushes up the price of gold. And then thirdly, it looks at real interest rates. It's a 10-year real rate. It feeds those into a regression model. So the blue line that you can see here is the actual price of gold. The red line is what the model is saying it should be based on those three variables: inflation, the strength of the dollar, and real interest rates. Because if interest rates are high, that pushes gold down. Now what you can see here is that currently gold is quite a bit above, 12% above the fair price, according to this very simple model. It's not a trading model, it's just a fair price model. And silver, I suspect, is as well. Yeah, so even more, by 26%. But apparently there are lots of people in China buying gold at the moment, a lot of central banks buying it. But maybe that's responsible for the increase in price. But your original question was what would happen if inflation goes up or down? Well, as it does track inflation long term, I'd expect gold to track inflation up if it increases, and to track faster if it increases more quickly. Inflation, we're not expecting it to fall to negative numbers. We're not expecting deflation. But yeah, gold I'd expect would track inflation up, but not really short term. If you expect gold to track inflation over the course of 1 month, 2 months, that's not going to happen. This is a very long-term trend that it tends to track. And of course those other variables, the other two, the strength of the dollar, interest rates, vary much more rapidly than inflation. So those will explain a lot of the short-term moves, whereas inflation shows a kind of long-term trend, which is what you can see on that graph. So as an inflation hedge, it's not great. You could use any commodity as an inflation hedge because they all track inflation. If they didn't, their price would go down to almost zero in real terms, or it would go to incredibly high levels, which would make it unattainable. So everything which is useful effectively is an inflation hedge in that sense. Gold's nothing special there. Tie colour, it was purple. So yeah, it was purple, which is his dovish one. That's my theory, and I'm sticking with it. Hope that helps. Oh, and David Smith gave me a super thanks. So thank you, David Smith. Appreciate it. That's great. And we've got 5 more minutes for my self-imposed 9:40 deadline. Last question, probably, is from UYU, who's one of our supporters on YouTube. And, oh no, that's the currency. Okay. Oh dear. So it's GCT prompt, and they paid in Uruguayan pesos. There we go. That's not a currency I'm familiar with. But GCT prompt says, what sector would you be more bullish on right now? And how would you get exposure to that sector? Well, probably the cheap one. You know, that's what I'd usually go for. So I guess you're talking about the US. So FinViz has a US sector expensiveness PE ratio. So let me pull that up. Here we go. I'll agree to everything. And yeah, here we go. Oh no, that's too granular. We got sectors. Yeah, that's better. So these are US sectors. And what I'm looking at here is the forward price to earnings multiple. And I'm going to sort it by that. So the most expensive is real estate, technology second, industrials third, then healthcare. The stuff that nobody wants. Energy, reasonably cheap. Financials, basic materials, utilities. So I can kind of see your reason for buying, if you've gone long, for buying the financials leveraged ETF because they're cheap. You know, I wouldn't buy a leverage version, but I think financials are interesting. I certainly had a position in financials, which I bought just after Silicon Valley Bank went bust, and that pushed all of the sector down. And then I sold it after it recovered. It took a while, but I made about 30% on that trade. If I'd have had a leveraged version of that index, I'd have made even more. But, you know, I don't usually like leverage. I'm a bit of an old man. I'm scared of leverage. But these are the sectors I'd favour. Now, utilities, defensive, boring, pays a dividend. I like it. Basic materials, unloved, not sexy, but we need them, and they're cheap. And then energy, you know, always interesting, always very volatile, very difficult to call. But energy prices, of course, have been suffering recently. They've been on a downward trend, and that's pushed down the energy sector. So yeah, that's probably what I'd go for at the moment for those reasons. Let's just see if we have another question. We don't. Okay, so we'll draw a line under it there, I think, because it's 9:40. It's past my bedtime. We just bought a new TV and we want to spend some quality time with it. So thank you all for joining us, and thank you for feeding Ted by giving us the super chats. We appreciate it. And remember, you can join our community. Just go to our website, PensionCraft.com, and you can see a section about our membership. And it's very cheap, and you get to chat to other people about investment, people who are probably in the same situation as you. We share information, we're helpful, and it's a great place to learn about investing. Or you can have one-to-one sessions with me. Again, just go to our website, PensionCraft.com/coaching, and you can learn how to book an hour with me, one-to-one, and we can discuss anything you like. Not advice, just guidance, just education. Use me as a sounding board for your ideas, your portfolio, your plans, and I'll give you my opinion about it. But I won't tell you what to do. And thank you for joining us again. And yeah, we'll speak to you again soon.